Welcome to our explainer on interest rate parity, a fundamental theory in international finance. Are you curious about how interest rates adjust to equalize returns on investments across different countries? You've come to the right place. Today, we're diving into the world of interest rate parity, often abbreviated as IRP. By the end of this video, you'll understand its pivotal role in the financial landscape. So, what exactly is IRP? At its core, IRP is a theory that helps explain the relationship between different countries' interest rates and their impact on currency exchange rates. It's essential for anyone involved in international finance, from economic students and finance professionals to investors navigating global markets. But why is IRP so important? It underpins many financial decisions, from currency hedging to investment strategies, by ensuring that returns on investments remain balanced globally. It keeps financial markets in equilibrium, making it a cornerstone of international economics. In this video, we'll walk you through the origins and development of IRP, its practical applications, challenges, and future trends. Ready to get started? Let's delve into the fascinating world of interest rate parity and see how it shapes the financial markets. Stay tuned as we explore IRP's journey through history and its impact today. In the annals of financial history, the roots of interest rate parity, or IRP, begin to take shape in the theories of early economists. These pioneers laid the groundwork for understanding the interplay between international interest rates and investment returns. Notable figures like John Maynard Keynes and David Ricardo were instrumental in linking interest rates with the broader economic environment. Their foundational ideas set the stage for what would evolve into the sophisticated IRP theory we know today. Let's delve into historical examples that highlight the early practical applications of these theories. From the cross-border financial activities of merchants to the nascent international bonds market, these examples provide a glimpse into the early workings of IRP. Interest rate parity is not an abstract construct, but a concept born out of necessity and practical observation, enabling investors and policymakers to make informed decisions in an increasingly interconnected global economy. As we chart this historical journey, we see IRP weaving through time, influenced by the thoughts and calculations of economic visionaries. Moving forward, let's explore the development of IRP theory and how it transitioned from historical context to formal mathematical formulation. As the global economy evolved, so did the theory of interest rate parity. Let's delve into the key developments and the mathematical formulation of IRP. In the early stages, economists began observing patterns in how interest rates across countries seemed to align more closely than expected. This led to a curiosity that birthed the preliminary frameworks of IRP. Key contributors like Irving Fisher and later John Maynard Keynes played pivotal roles in the maturation of this theory. They not only noted these patterns but provided crucial insights into the mechanics behind them. Fisher's work on the Fisher effect laid foundational principles, while Keynes' contributions helped refine the theory. As these ideas evolved, the need for robust mathematical formulation became evident. This gave rise to the formal equations and models that economists use today to predict and explain interest rate movements across international boundaries. By capturing the relationship between interest rates and exchange rates, these formulations have become indispensable tools in international finance. As we move forward, you'll see how these mathematical frameworks provided clarity and enabled practical applications that continue to influence global financial markets profoundly. To understand interest rate parity, we need to delve into the intricate relationship between interest rate differentials and currency exchange rates. Interest rate parity, or IRP, operates on the principle that the difference in interest rates between two countries is offset by the exchange rate movement between their currencies. Here's how it works. Imagine two countries with different interest rates. The country offering a higher interest rate attracts more investments, increasing the demand for its currency. Consequently, this shifts the currency exchange rates to balance out the return on investments across different regions. When interest rate differentials exist, the currency of the country with the higher rate is expected to appreciate against the currency of the country with the lower rate. This appreciation continues until the added interest earned is negated by the loss in exchange rates, leading to a parity condition. This concept ensures that investors no longer have an arbitrage opportunity to gain from interest rate differentials. As we move forward, you'll see how these theoretical principles apply to real world scenarios impacting global finance and investment strategies. Let's look at some real world examples to see how interest rate parity plays out in practice and its impact on investments. Case studies provide concrete illustrations of how this theory influences financial decisions. One notable example is the impact on currency hedging strategies. Investors in different countries leverage IRP to balance their portfolios and minimize risks associated with currency fluctuations. For instance, consider a U.S. investor looking to invest in European bonds. By applying the principles of IRP, they can gauge potential returns while accounting for exchange rate movements. Furthermore, practical applications extend to multinational corporations managing cross-border trade. Using IRP, they can make informed decisions on where to allocate resources to maximize returns. The theory helps them navigate complex global markets, ensuring more predictable outcomes. As we delve deeper into these examples, it's clear that IRP not only guides individual investors, but also shapes broader financial strategies. Through these real-world scenarios, we gain a more vivid understanding of IRP's multifaceted impact. As we move forward, you'll see how these principles manifest in modern financial markets and their relevance in today's global economy. Interest rate parity remains highly relevant in today's financial markets. It serves as a critical tool for investors and financial analysts alike. By understanding IRP, financial markets can predict how interest rate differentials between countries affect currency exchange rates and investment returns. In the modern global landscape, IRP facilitates international investments by mitigating risks associated with currency fluctuations. It ensures that capital flows efficiently across borders, promoting balanced and fair trade relations. Institutions utilize IRP to hedge against potential currency risks and optimize their portfolios. Moreover, its impact on global trade cannot be overstated. By aligning interest rates and exchange rates, IRP supports stable economic relationships between trading partners. This stability is crucial for businesses engaging in international commerce, as it provides a predictable framework within which they can operate. As global financial systems become increasingly interconnected, the principles of IRP gain even more significance. Investors and policymakers rely on it to navigate the complexities of the modern economy. As we move forward, let's delve deeper into the challenges and criticisms of IRP, exploring the real-world obstacles it faces and the solutions economists propose. While interest rate parity, IRP, stands as a cornerstone in international finance theory, it faces an array of challenges and criticisms. Some economists argue that IRP's assumptions don't always hold up in the real world. Critics point out that factors like government interventions, transaction costs, and differing risk levels complicate its practical application. Additionally, IRP assumes that capital markets are perfectly efficient, a condition rarely met in practice. Real-world data often show discrepancies, reflecting these limitations. It's crucial to understand these criticisms to fully grasp the intricacies of IRP. For instance, empirical studies sometimes reveal inconsistencies in how interest rates and exchange rates adjust, highlighting IRP's theoretical gaps. By acknowledging these challenges, we can approach IRP with a nuanced perspective, recognizing its utility while being aware of its shortcomings. As we move forward, you'll see how these criticisms pave the way for ongoing research and potential refinements in the field, ensuring that IRP continues to evolve and adapt in a dynamic financial landscape. As we look to the future, it's important to consider how interest rate parity might evolve with emerging trends and technological advancements. The financial landscape is rapidly changing, driven by innovations like blockchain, artificial intelligence, and big data analytics. These technologies could revolutionize how IRP is calculated and applied, offering more precise predictions and unprecedented insights. Moreover, shifts in global financial policies and the increasing interconnectedness of economies will play crucial roles in shaping the future of IRP. As new markets emerge and existing ones evolve, the dynamics of interest rate mechanisms will also transform, potentially leading to new models within the IRP framework. Envision a world where real-time data flows seamlessly across borders, allowing for immediate adjustments in response to market conditions. This future presents both opportunities and challenges for economists, investors, and policymakers. Adapting to these changes will be essential for maintaining the relevance and accuracy of IRP. As we move forward, you'll see how these trends might unfold and what they could mean for the future of global finance. Stay tuned for expert insights that will shed more light on the possible directions of interest rate parity. To gain a deeper understanding of interest rate parity, we've turned to the experts. These professionals bring a wealth of knowledge from the world of international finance. First, we'll hear from Dr. Samuel Green, a renowned economist. He'll discuss the theoretical foundations of IRP and how it serves as a bedrock for financial decisions in global markets. Next, we'll get insights from Maria Lopez, a leading finance strategist. Maria will elaborate on the real-world implications of IRP, particularly in today's volatile economic climate. Then we have Professor John Kim, who will share his research on the future of IRP. John will provide a glimpse into how technological advancements might influence interest rate dynamics across borders. Finally, we'll wrap up with insights from Jane Patel, an investment analyst. Jane will explain how investors can leverage an understanding of IRP to make more informed decisions and maximize returns in an increasingly globalized economy. These expert opinions will paint a comprehensive picture of IRP, demonstrating its relevance and application across various spheres of finance. As we move forward, you'll see how these insights can be integrated into practical scenarios, providing valuable takeaways for students, professionals, and investors alike. In conclusion, we've journeyed through the intricate world of interest rate parity, unraveling its historical context, delving into its theoretical developments, and witnessing its modern applications. From understanding how interest rates adjust to equalize returns across borders to exploring the real-world implications, we've covered it all. Moving forward, we see how IRP continues to evolve, driven by emerging trends and technological advancements. As we reflect on these insights, it's clear that interest rate parity remains a vital concept in international finance, guiding investments and economic policies worldwide. We hope this explainer has deepened your understanding and sparked your curiosity to learn more. Thank you for joining us on this educational journey. If you found this video helpful, please give it a thumbs up and share it with others who might benefit. Don't forget to subscribe to our channel for more insightful content on economics, finance, and beyond. Stay tuned for more videos that unravel the complexities of our global economy. Until next time, keep learning and stay curious.